Welcome, everyone, and thank you for joining us today for our program, Putting the Pedal to the Metal Using Accelerated Gain for Your Next Transaction. We included this slide so you could see our contact information, and also we could note that it's not unethical to include your high school graduation picture in a slide presentation. Some housekeeping before we get started. At any point during the program, you may submit a question by using Q&A button at the bottom of your screen. We will turn to the questions at the end of the presentation if we have additional time. If you're having any audio or technical problems, please use that Q&A button and our marketing folks will help get those resolved. Finally, no need to write anything down. We will circulate this deck separately after the presentation is over later today. So Conrad, help get us started here. Please give me an overview of the aspects of the proposed tax legislation that have some clients interested in accelerating gain this year.
Sure. Thank you, Larry. Good morning to everyone. One of the purposes for this presentation that we're putting together, as many of you know, there's a bill in Congress and it's been stuck in Congress. It was supposed to get voted on last week. Now we're hearing October 31st, but for those who are conducting business in the M&A world, there's a lot packed into this bill, but I think here are some very important matters with respect to just thinking about individuals. One of the biggest changes is the capital gain rate. The proposed increase is going from 20 to 25%. And I think what caught everyone a little bit surprised is it's going to be effective after September 13th, 2021. I will note there is some debate is whether it's actually September 13th or the day after. And one of the carve outs is that if you have a binding contract that's been executed before that date, then you will get the benefit of the 20% rate. And as you can imagine, there's already been some questions about a binding contract. And if you have an M&A agreement already signed, but if you need a third-party governmental approval or something that they can throw out of the deal as to whether or not that's a material modification. We do not know. We hope that it will be similar to the binding contract rules that we see in the accelerated depreciation. I will say the one thing that is clear is that an LOI is likely to not be covered as a binding contract, nor should it be based on the language. The other issue I think that's important is for those of us that have a lot of clients that do business as an S Corp or an LLC, there's always been what people have called it's the net investment income tax, but it's always been called the Obamacare tax, that if you were a passive shareholder and flowed through entities, this was an additional tax that you would incur. And if you had a corporation, this tax was already there. Well, one of the big adjustments in the law change is that if you're an active participant, you don't get a carve out. So if you're an S corporation or an LLC or any other entity taxed as a partnership, this 3.8% will also be employed against the income that you have. And then there's basically surtax that if you have adjusted gross income of $5 million, it doesn't matter what kind of income you have, you're going to pay an additional 3%. So when you take the cumulative impact, say this were to pass and all of it is effective on January 1, 2022, you're looking at a typical capital gain transaction of all of these apply is now up to 31.8%. The other issue that you have is if you had a corporate rate, which had been 21%, if you have more than $5 million of income, I'll go to 26.5%. And the top individual rate is going from 37 to 39.6. So you're seeing adjustments in all the rates that could apply. Larry, next slide, please.
Well, Connor, before we go there, who should consider accelerating gain this year, and what are the techniques that may trigger that gain?
Yeah. So one of the things we've talked about, Larry and I, and looking at this is if there's really two things that are going on here. If you have clients that are knee deep in diligence and looking at who can possibly get the benefit of the rates, I think if you have a sale lined up and you think it's going to happen first quarter 2022, that would be one of the primary considerations. But again, you're accelerating tax, which you don't, pardon me, you can't undo that box. The second clients we're seeing are the ones that closed transactions and earlier this year or even in 2020 that took rollover proceeds. And rollover is just a way of taking a piece of your existing business, rolling it over into another entity and not paying taxes on it. So that recipient typically has cash plus a share of rollover equity. And we've had a few of those individuals that have gotten the benefit of that, or more than one member come back and say, maybe we should consider accelerating our taxes for that. So I think the basis of this presentation is to look at this various manners of how we can do this, Larry, in terms of electing out, and we'll talk more about these ones individually, but electing out of the installment method. If you have a deal this year, do you make your rollover equity taxable? What if you have negative capital accounts, or can you create them utilizing a leverage distribution with S corps and or a partnership? And then some of the things that you need to be particularly concerned with in terms of, pardon me, if you're going to do an acceleration of gain in related parties. There is one thing I'd like to say that I didn't mention on the other side that I think legislatively is important, is there was in a corporate world, there's a certain stock called 1202 stock that if you hold it 5 years, the Trump Act had actually got it to a position where if you held it 5 years, you would get $10 million tax-free. And there's a new change in the statute. It's the 1202 actually gives you $10 million or 10 times whatever your investment the greater of. So if you put 10 million in, you get 100 million. So I think that with the Trump Act, what they've done is try to carve this back, which basically says if you make 400,000 or more, you're only going to get 50% of that benefit excluded. So basically it comes out to an average tax of like 18 to 20%. So I think there's been a lot of difficult issues on choice of entity. I also think that's important for exit, because if you're relying on 1202, be aware of that. So, and Larry, and looking at this, these are kind of what I'm contemplating. I know you had some fiduciary issues that we needed to talk about if before we head off in detail one of these, about kind of what needs to get considered in doing this.
Sure. Yeah. So in any of these transactions that Conrad's going to talk about, you're going to have to take into account the other members or shareholders and whether this has a negative impact on them. And if it does, you're going to want to have the right type of approval to make sure that those folks have a fully informed vote to approve the particular transaction. So Conrad, why don't you give us a little more specifics on how you would go about electing out of the installment method?
Sure. Let's talk about the installment method. The good thing about the installment method is, of course, it's usually advantageous to taxpayers when you get cash up front plus a note, or the other things that are eligible for installment obligations can be holdbacks for reps and warranties, contingent consideration, and any other kind of escrows that you have to sit for a variety of reasons. Typically, a lot of those pools of money are available for installment treatment, which means you don't recognize that gain, especially if it's capital gain. Well, only if it's capital gain in the year of receipt. Okay. So one of the things that you could do, say that you got a deal and it's closing this year before all this is enacted, or you have a stream of an installment sale coming up. The question is, if you have the other two additional, the 3(8) and 3, as an individual taxpayer, even if you hold it through a flow-through entity and it's been distributed out, or even a flow-through entity, you can always make an election to elect out of the installment sale method. And what that does is it lets you pay taxes today rather in the year of receipt. All right, now that's a big issue to think about in terms of you're kind of doing what I call backward tax planning. Like the goal of tax planning is to defer, the question is, when you have accelerated rates, is it better to pay it at today rates rather than tomorrow rates? And it's a little bit of a financial analysis as to whether you do that. I will say that if you have contingent considerations or escrows or holdbacks that you're concerned about, you can actually value those at something less than the face value and still include it. So you're picking up a majority of your income. And of course, you don't get installment sale method treatment if you have ordinary income like receivables or inventory. One of the other things is that if you have a current installment sale that you're getting paid on and you want to trigger it, there's some things that you can do, like secure it with collateral, try to incorporate a transfer, by pledging the note or using a related party transaction sale to actually trigger the gain. I think the biggest issue, Larry, with an installment sale sort of transaction is, do you do it? And once you do it, you can't unwind it. The good thing about electing out for all of you is that if you're an individual, you can push that election out till you file your return, which for many people will be October 15th of 2022. So you have the benefit of looking at that kind of over time as to whether or not it's in your best interest. And if it's a pass-through entity, September 15th in terms of doing that.
So on that one, separate from obtaining fellow member consent, the other issue is you only get to elect once. If you elect into it, you can't elect out of it.
That's correct.
So tell us a little bit about how you deal with negative capital accounts.
So the other thing that's been coming out for a lot of folks is you can couple this, and it also goes to the next topic a little bit with it, is if you have an existing partnership that has a negative capital account or an LLC, or say you went and did a leverage distribution a few years ago, or you have a sale, and this is one of the things that Larry and I will touch on more in detail. You get the bank to go make you a loan and you take the cash out. One of the things we're saying is, all right, how can I trigger a negative capital account? And so exactly how would I do this? Well, it's easy, but there's a lot of issues you have to contemplate associated with that, including, your buy, sell, and your transfer provisions in your operating agreement. But one of the things you can do, and what we've seen some of the bigger four accounting firms recommend, is you as an individual set up a single member LLC disregarded entity. All right. And I would suggest you do this later in the year, like in December, if you can do it at the time, and put that partnership interest into it that has a negative capital account. And then what you would do is just check the box to make that entity a corporation, and then make probably an S election for it, so you can continue flow-through treatment. And what happens is, when you basically incorporate the partnership in there, you've transferred that negative capital account into a new corporation. And under the tax rules, if the liabilities are in excess of basis, i.e. your negative capital account, you end up triggering gain. And most of that gain, almost all of it, should be capital gain associated with that transaction. But if you really think about it, is if you utilize the check the box election rules appropriately, you can actually have until 90 days after you form that entity to go back and retroactively make that check the box election. So what you're doing is accelerating gain by doing that election, Larry.
So Conrad, what are some of the issues with doing that? For example, what happens if you thought a deal was going to close in the first quarter and it never closes? And
I think the biggest issue, Larry, like you said, is once you make that election, you can't come back from it. So, if your deal doesn't close, you're going to owe taxes to the government, and you may not have any cash on hand. And that puts you sort of at a disadvantage in terms of looking at it. And I think that's the business decision that you have to contemplate.
And how about holding appreciating property at an S corp?
Yeah, and the other property is, once you get it in an S corp, you can't take it out without triggering gain. And the other thing to think is, if it generates losses, it's going to be stuck because you don't have basis outside the S corporation.
So, I mean, the last item on the slide here is distributions in excess of basis through leverage distributions. If you could just touch on that quickly, and then we'll wrap it up.
Yeah, I think the thing is similar to this is, can we go get a bank if we know we're going to close to give a loan to the S corporation, let us distribute it out. And because we have no basis, because the loan does not create basis, we'd actually recognize gain on that distribution. And so you would trigger it. And I think it's the same, and then you could take that money, put it in an escrow that the bank would secure, and the bank should hopefully feel protected. But I think one of the things we talked about is you need a bank that's willing to do this, and you got to be careful that the IRS doesn't step through the whole transaction. I will tell everyone on this that we're talking this presentation is you have to be very careful whether it's the negative capital count 351 or a distribution in excess of basis or converting an S corporation to an LLC, which is a liquidation and give you gain, of the related party rules. Because if you don't watch it, that could make all the gain ordinary income, and you've just totally destroyed the whole reason of why you're trying to accelerate gain.
Thanks, Conrad. I think that's the end of our presentation. So given that we are a little short on time, we'll just have to follow up with everyone with the slide deck later. And thank you very much for joining us. We appreciate your time. Conrad, great job.
Yeah, thank you all for joining us. And there is one question, I'll respond to it outside of this context. Thank you all.